Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing the Lion Electric Company stock so we can determine if it's a buy or a sell. The Lion Electric Company is a manufacturer of commercial vehicles. It mainly produces yellow school buses, public transit buses, semi-trucks, bucket trucks, and garbage trucks. All of its products feature zero-emission battery electric powertrains. The company is headquartered in Saint Jerome, Quebec, Canada, and was founded in 2011. Let's get started with the model. This is a small cap company, 616 million market cap. They're trading at $2.79 a share, and they have 221 million shares outstanding. We're going to look at the ticker that trades on the TSX, so all the numbers in this video are in Canadian dollars. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They do have negative free cash flow, and it gets worse each year from negative 22 million to negative 327 million. You can expect a company to have negative free cash flow in the early years, especially a manufacturer, because they have to spend a lot on CapEx, capital expenditures. They have to buy warehouses, equipment, so it does take time to break even. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was negative in 2019, 2020, and 2021. A really strong sign is it's positive in 2022, positive 18 million. Don't worry about the negative free cash flow. That's probably due to CapEx spending. The fact that they had their first annual accounting profit could be an indication we could see greater growth in the future. Revenue is a sales for the company, and that grows pretty well from 30 million to 140 million. Let's look at their capital structure. They have 437 million of equity, 174 million of debt. They're 72% equity, 28% debt. Their net debt is 86 million, and they have a really high WACC, 13.8%. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 1.1 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $575 million. We divide that by 221 million shares. And we get a calculated stock price of $260. They're trading at $279, so they're trading at a 7% premium. It's a sell according to the model. 4 analysts priced this stock, and the average price target is $645. They're saying it's 128% undervalued. This is where the stock has been trading since they IPO'd. It looks like they IPO'd in May 2021 at about $21 a share. And it didn't get much higher than that. It did hit, I think, close to 23 after a couple of months. But ever since that peak, it's only gone down. It looks like it's down over 90% since that peak. So you could have made a lot of money if you shorted the stock. You really need to understand the future potential of the company. How many vehicles do they sell? What are their margins? What's the competition like? It could be a really great buy, a really great opportunity because the stock price is so low. Lots of buying and selling. When there's a red line, that means the sell orders are higher than the buy orders and the stock price goes down. When there's a green bar, the buy orders are higher than the sell orders and the stock price goes up. It's hard to tell on this chart, but if you made it smaller just these few months, you would see a pretty big spike right here. There are 28 companies in the same industry as Lion, and Lion doesn't pay a dividend. They rank 18th out of the 28 companies at 600 million market cap. I converted all the market caps to Canadian dollars. They do have a good price to book, probably because they raised a lot of money from issuing equity. They do not have a good PE, but it is positive, so that is a good sign. We can't look at their price to free cash flow, and their price to sales is a lot worse than average. So to summarize, I have them trading at a 7% premium. I rank their free cash flows 1 out of 10, their revenue 5 out of 10, and their ratios 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.